Welcome back. Today, Urmi and I are joined by Ben Rabidoux, a leading housing analyst at Edge Realty Analytics. His firm provides deep insights into Canada's housing market, offering data-driven research on national trends and metro level shifts. Ben's work is widely followed by real estate professionals, including myself, for good reason. His research doesn't just track home prices, it digs into broader economic signals from consumer confidence to micro trends that often fly under the radar. And if you're trying to make sense of how all these changing macroeconomic conditions, from higher inflation to lower rates to tariffs, might impact our broader economy and housing market in the months ahead, you won't want to miss today's conversation. I hope you enjoy our discussion with Ben Rabidoux. All right, Ben, thanks so much for joining us again on our show. It's been, I think, maybe a couple of years since we've had you on. It's been a while, I feel, since the last time. So obviously great to have you on to help us make sense of everything that's going on, macro-wise, housing-wise. And of course, as always, we have Urmi Desai joining us as well. So I'm going to kick things off, Ben. Talk about the latest inflation numbers that came out this week. Surprised most people, went up to 2.6. I think some of the headlines was that it's partially due to the end of the GST holiday. What did you make of the data, and how it's going to impact sort of the outlook for the Bank of Canada going forward?
Yeah, absolutely. Good to see you guys again. Thanks for having me on. The inflation data today was a surprise. We were expecting it to tick up. It came in considerably above where markets were expecting. Markets were expecting somewhere around 2.3%. It came in at 2.6. There's more going on than just the GST. If you So one of the dynamics that I was flagging for my Edge Analytics subscribers was that some of the forward indicators for inflation we're starting to perk up noticeably. So in particular, like two things that people would want to pay attention to if you're trying to figure out where the cost of living might be going. One is industrial product prices. So the prices of goods as they're leaving the factories, basically. And we've seen like a notable inflection higher in that. And part of that is related to weaker currency, pushing the price of raw materials higher. So, there's been some talk for a while about weaker currency feeding through inflation. So we're starting to see that. That's one thing. The second thing that we're tracking that has a really clean correlation with core inflation is if you look at the CFIB, which is the Federation of Independent Businesses, they do this monthly survey of their members. And a simple question that they ask is, well, how much do you expect to be raising your prices in the next year? Right? And that simple question does a really good job of predicting where inflation is going to go. And if you look at that survey, it's had this noticeable inflection higher in the last couple of months. So those two things, I mean, among other things, but those two things have been things that like I've been looking at thinking, geez, that looks like we're set to get some hot inflation readings. And sure enough, we got them. Now they came in hotter than even I would have expected. So in terms of what it means for the Bank of Canada, this is a really tricky time for the Bank of Canada. They're trying to walk this tightrope between sort of front running a dramatic deceleration in the economy, which I think we're seeing in real time, right? These tariff concerns are a real issue. They're suppressing consumer confidence. They're suppressing business investment. They will impact the economy. So they're trying to front run that. But at the same time, they're walking this tightrope where they understand that because the currency has fallen so quickly over the last year and a half, you're starting to get this feed through from higher input prices. And so it's this balancing act of trying to stimulate the domestic economy, fight off the worst of this economic downturn, but be mindful that as you do that, you're likely going to impact the currency and you run the risk of having inflation run a little hotter. So the roadmap that I've been laying out, and the way I've been thinking about it with my subscribers is, and we had this laid out kind of, Q3 of last year, is that the Bank of Canada is going to be aggressively cutting through the first half of the year. And I think the overnight rate still has to get down to closer to 2%. But towards the back half of this year, some of the concerns will start to shift towards the impact of the weaker currency on the inflationary pressures that we're seeing. And so I think we're going to get down to 2% on the overnight. I don't think it's going to get lower than that. So the good news for your listeners is that probably means we're going to be looking at mortgage rates in kind of the low threes, maybe maybe the high twos on like insured products this summer. But we're not going back to those zero rates, those kind of like 1.1% fixed rate mortgage that we saw at the lows in 2021. That's
Mhm.
just, we're just in a different world.
So how do you, I mean, I'm curious, how do you see the rate environment going down if inflation remains elevated or potentially even ticks up a little bit from here? I mean, obviously not where we were 2 years ago, but in an environment where the banks concerned about inflation picking up, how do they cut? Because I would think that they're focused on price stability rather than the economy. So, but you would still see them cutting even with rate inflation gradually ticking up a little bit?
Well, like it's harder for them to do it, right? And so you saw the response in the bond market today. The bond yields were higher. So there's a recognition that this inflation is complicating things for the Bank of Canada. You have to remember the Bank of Canada, there's not a hard and fast rule, right? Like it's not like the moment that inflation gets above X, the bank has to start tightening. We saw that during COVID, right? We had inflation up, 5, 6, 7%, and the Bank of Canada was sitting on the sidelines. So there's no hard and fast rule. And it's important to remember that, they have the leeway to sort of determine whether what they are seeing in the inflation print is likely to be temporary or what they would say is transitory, which they're not always right in that diagnosis of whether something's transitory or not. But the reason that I would flag that is, so for example, in the most recent inflation print, one of the things that really pushed inflation higher was like travel expenses, right? Where all of a sudden we had this huge increase in like hotels and airline and anything related to travel. And you go, well, what would that have been? And I think there's two things at play there. One is that maybe you could make the argument that the weaker currency, we're starting to see a little bit more tourism come into Canada. Okay, that's good. But on the flip side, I think one of the things we're seeing is people that were planning to go stateside have said, I just don't feel comfortable spending my dollars in the US. I'd rather stay here. So if you're the Bank of Canada and you look at that dynamic, like, do you believe that's going to be a permanent feature? Do you think it might be transitory, right? And that's just one example where they might look at something and go, geez, this, maybe you get like a boost for a little while from this. Do you know what I'm saying? So
Yeah,
my
100%.
read would be that they'll choose to look at this as being mostly
Short term.
transitory.
Interesting. Okay.
Right. But then come the back half of the year, I think that's where things get a lot more complicated. And that's why I don't see them getting much below 2% on the overnight.
Interesting. Now, how much of this inflation do you think is being driven by Canada's trade war with the US?
Well, nothing really directly yet. And it's important that people remember that when the US puts tariffs on Canada, those are prices that are paid by the importers in the US. So it does not have a direct influence on our prices here. Now, what runs the risk for us is if we start to get into this tit for tat, reciprocal tariffs where we then put prices on things that we import, then you run the risk of creating some significant inflationary pressure. So the short answer is there's been nothing directly yet in the CPI print, although you could make the argument that some of that travel related stuff last month maybe was sort of tariff related. But there is a chance that that starts to become a problem down the road, more so through these reciprocal tariffs.
Now, Ben, on that note, one thing, people that work sort of or abide by tariff or low tariff theory when it comes to international relations, that's what I was trained in. They are motivated by two factors. Tariffs or the threat of tariffs has a tendency to motivate businesses in their price setting. So one thing that happens is whether the tariffs come in or not, a lot of people start pricing in anticipation because they want to offset shock. But another thing that happens is that domestic producers do often start raising their own prices up. So, for example, in the United States, one thing they might see is they might think this is advantaging US companies who can sell at a lower price. But if people are used to having a certain price, often they will price up. In other words, tariffs make uncompetitive businesses look a little bit more competitive or viable. So how much of that is being already priced into inflation, even though the tariffs may not take effect? And you noted that it's the business surveys that started to track this already. I get the concerns about low currency, but I'm wondering when the timing of those inflation concerns really started? Was it, for example, after November 5th?
Yeah, it was. Yeah. And so I hear what you're saying. And I would maybe just to clarify for the listeners, when you talk about the businesses raising the prices after tariffs are announced, you're talking about the domestic businesses like in the US that would be raising their prices,
Yes,
not
and
necessarily the Canadian
and
businesses.
Canadian as well. Like a lot of it can be anticipatory because like this is a challenge we've always had, right? Businesses don't pass on costs as they are. They do pre-planning, they try to iron out
Mhm.
shocks, they'll try to raise their prices slightly ahead of time to buffer, right? So how much of that inflation is already related to tariffs, even though the tariffs themselves may not be taking effect?
Yeah. So what's tricky is like, and so it's a good question. I'd have to look at where I think you would see that is when you look at like durable goods as like a really simple way to think about it. So things that are being manufactured, um, you would expect that if because that's really what the tariffs that we're talking about right now. We're not talking about tariffs on services. We're not really talking about tariffs on, energy. It's really tariffs on durable goods at this point. So you would expect to see it show up in that component of the CPI. Now, we can do this real time. Let me pull up the data, but I don't, off the top of my head, I don't think that the big increase we saw last month was confined or was more pronounced in the durable goods. I'd have to get back to you on that. So I still think the short answer would be that I don't think we've seen a meaningful impact from the tariffs on that component yet. I think what we're seeing is, at least to date, it's more so in the some of those like more tourism focused areas for now.
Sure. And if the tariff wars continue and we start to see the tit for tat and other aspects intensifying, what do you think will happen? I mean, I think some of the fear is that the businesses don't even just pass on the tariffs, they pass on a little bit more because the fear of planning for your goods, right? And the cost starts to play into businesses. It's the same reason why banks don't like inflation. It has a way of distorting your economic behavior, right? You start stockpiling or hoarding or
Mhm.
upping your prices. So, what do you think if this kind of energy doesn't abate on the trade war front? What do you think we'll see in the next 6 months? Do you think we'll see people finally getting tired? And by people, I mean a certain leader south of the border. What do you think would happen?
Yeah, look, you're absolutely right. Tariffs are unquestionably inflationary, right? So there's no way around it. They're inflationary in the sense that they raise the cost directly for consumers through the tariffs themselves. But you're also absolutely right. They change the buying patterns. They change supply chains. Everything about them is inflationary. So there's no reason to think that if we don't get into an escalated tariff environment of like a lengthy period of escalating tariffs, that it won't end up being more inflationary in the longer term. No question there. As to how bad it gets and where we go from here, like, man, you really start to speculate and you get into trying to kind of divine the inner thoughts of Donald Trump. And like, that's just not somewhere I would claim to have any unique insight. What I have been saying to my clients, my subscribers is, at some point you have to anchor off of something as you're trying to think about a framework around tariffs. And it seems really clear that tariffs are a core part of Donald Trump's platform, right? But if you listen to the comments of his Secretary of Commerce, right, Howard Lutnick, who is the person who's sort of been tasked with crafting these tariffs, he's very clear that there's sort of two major buckets of tariffs, and the first is these sort of tariff threats targeted specifically to the United States border partners, so Canada and Mexico. And they're more designed to kind of get those partners in line with issues of perceived national security in the US. So fentanyl flows, illegal immigration, that stuff. But they're not intended to be permanent. And this is coming from his testimony in his Senate confirmation hearing. Behind those tariffs are the more permanent tariffs. And he's very clear that they want to roll those out gradually. They want to be thoughtful about those because they do recognize that they will be inflationary. They will likely be a lower level, so probably something more like 10% on manufactured goods and some sort of a carve out for energy. That I think is where we're going. So this first iteration of tariffs that everyone's freaking out about, I really don't think is the big story. I think these are meant to, like, they will be dropped once I believe, we've reached some sort of understanding around these border issues, whether you believe they're legitimate or not. But and then this summer we get the more permanent tariffs. Now, remember, if we get a 10% tariff and you get a decline in the currency of about 8%, it largely offsets it. So these tariffs can be largely offset by a decline in the currency, which I do expect, right? So I'm not sure that they're going to be as disastrous as people are suggesting, but they are certainly disruptive. And more importantly, I think the big story for now is, they're having an immediate impact on things like consumer confidence and business investment. And you folks are seeing it because when consumers lose confidence, they certainly don't want to pull the trigger on $1 million house purchase, right? So that's, and I'm sure that segues into something that you guys eventually want to talk about, which is the housing stuff.
Yeah, definitely. Before we do that, I thought I'd unpack one thing you said, which is interesting, which was, if we do see a 10% tariff and the currency dips 8%, you mentioned they kind of offset each other. But to clarify, you're speaking from Canada as an exporter's perspective, meaning
Correct.
tariffs are up, but currency's lower, so our goods are cheaper in US dollars. So it's like nothing happened almost. But for a country that's importing, right? If we're paying 10% more on the goods we're importing, on a bunch of them, and our currency's lower, well, the inflationary pressure is amplified, correct?
100%. Yes, 100%. Yep.
Okay.
And so you're in a situation where the Bank of Canada has to choose. Look, this is ultimately, this has been my view for years now, which is that fundamentally Canada's economy is far too levered off of highly cyclical, interest rate sensitive dynamics like housing and consumer spending, and is not nearly geared enough towards exporting, manufacturing, et cetera. And so one of the ways that you rebalance that economy is you do need a lower currency for a period of time, right? You do need to allow that to facilitate that transition, to allow the deleveraging that needs to happen at the household sector. So I think that's where we were going anyways. I just think that these tariffs sort of accelerate that dynamic. I've always said, I think, like for years now, I've said, before this kind of current cycle is over, I think we're going to go retest the lows in the Canadian dollar vis-a-vis the US, which is around the 62-cent mark. I still think that's right. I just think we're going to get there quicker with these tariffs.
Interesting. Now, going back to your earlier comment, how does all of this play, like all of these economic concerns, the tariffs, the currency, inflation, how do we see the interest rates? How do you see this all feeding through to the housing market? And maybe we'll just start with resale, because that's kind of the first thing people think about. How does do you anticipate this feeding through in house prices over the next 6-12 months?
Well, I think the first thing to note is that we have seen an immediate response in consumer confidence following the election of Donald Trump. All right. So we have seen a dramatic decline in consumer confidence. It has only accelerated since the whole, 51st state tariff talk. If you look at the Conference Board's data on consumer confidence, we're basically at levels that we've only seen twice previously, once during COVID downturns, once during the financial crisis. So we are seeing just an incredibly depressed level of consumer sentiment. And it's just not conducive to making major purchases. So it's not entirely surprising that housing sales have been as soft as they are. I would say that I think, and maybe you would disagree with me on this, John, but I do think part of the decline that we saw, that big 28% seasonally adjusted decline in sales in February, I think that's overstated if you look at just how snowy. I don't want to pin it all on the weather, but look, it's a real thing. If you look at the chart on how much snow there, snowfall days
For sure.
versus any other year in the past 20 years, we had a really exceptional year.
That's fair.
I wouldn't discount that completely, but that said, you look at every major metro across the country, you had anywhere between kind of 10 and 15% decline in sales seasonally adjusted. So to me, that's a confidence issue. It's blanketed right across the country. So that's where you're going to see it first. Now, unfortunately, this higher inflationary dynamic, especially as we get kind of towards the second half of the year, I think will put a floor under rates. There is still downside to rates. They will still go down from here. The Bank of Canada will still cut from here. but we're just not getting back to those ultra low rates. So I think we'll see a floor in around that 2% range. That means there will still be an improvement in affordability. The good news is wage growth is exceptional right now. It's probably the most underreported story in Canada, is just how strong wages are right now. We're basically sitting at like 20-year highs for wage growth, which no one's talking about. So we're seeing really strong wage growth. That helps on the affordability side. So you get rates come down a bit, affordability, wage growth increase. We see prices continue to kind of flatline or maybe melt a little bit. Like, it will help on the affordability front. It's just that we're not going back to those boom times that we saw in 2020 to kind of early 2022. It's just going to be a bit of a grind. And unfortunately, until we get clarity around these tariffs, I just think all major purchases are going to be on hold. So this may not be I was expecting 2025 to be a pretty decent year for home sales, just because of how low they've been on a per capita basis for a couple of years. There is clearly some pent up demand. I just think now we've pushed that out a little bit, and maybe that'll be maybe a second half story when we really start to see that demand return.
Yeah, 100%. The market was showing signs that it was going to be a busy year at the end of last year. It looked like it, but you're right, everything got sidetracked. Now, the one thing I'm kind of curious about is, you mentioned rates hitting a floor at 2%, but I wonder and I worry that if we're in this higher rate environment in the second half of this year, are we going to be in this place where the bank's hiking again if they need to fight higher inflation? Are we going to be in this sort of this stagflation environment where we have a high inflation, low economic growth? And do they sit at 2, or are they hiking rates to fight that?
Yeah, it's a real risk. That is a risk. Like I would have said 6 months ago, that was a really low risk, and today it's clearly not. We're already seeing some signs that those pressures are building. So as with everything, when you're talking kind of projections, you sort of have to anchor on a base case, what you think is most likely, and then you have to recognize that there's tails on either side of that, right? Maybe it's going to be better than we think, maybe it's going to be worse than we think. So no question, that is a risk. In terms of what I think is most likely, I still think it's around that 2%, and then the bank has sort of a long period of wait and see. But that risk that inflation resurfaces, that the U.S., especially if the U.S. Federal Reserve really sits on hold or starts raising, that could put a lot of upward pressure. Could force bond yields higher and affect fixed rates. It's a lot more complicated than it was a couple months ago. So those are real risks. I think they're lowish risks for now, but certainly not zero.
I'm wondering, Ben, if there's a difference in the type of inflation we're seeing. So in the COVID period, we saw inflation introduced by stimulus, economic stimulus, and a lot of it. The kind of inflation we're now looking at, it's generated through uncertainty. And we think this tariff situation would make it worse. Is that a bit of a different type of inflationary fight for the Bank of Canada?
Yeah, no question it is, because when they were really trying to constrain demand, I mean, we had a situation where you had supply chains globally that were snarled coming out of the pandemic. You had a situation where the labor market was very tight, so you had this kind of feed through via wages, and it was much more a domestic inflation story. What is different this time, and one of the reasons why I think the bank still has some leeway, is there's two big dynamics that are going to start to weigh inflation actually lower, believe it or not, that are going to offset some of these inflationary pressures that we're talking about from the weaker currency. So one is rents. So according to the Bank of Canada, rents are still rising 6% year over year. Now, yeah, I said, John, I saw your face, right? Yeah. So you and I both know that's not really a reflection. There's a lagged impact based on how they calculate rents. Rents are not rising 6% year over year, right? Yeah. You and I both know that. Now that's 0.4 percentage points of headline inflation. That's going to go to zero, right? Like, you're going to have rents will pretty much start to flatline towards the end of the year. The second one that is still a major dynamic is that mortgage interest costs are still adding about 0.5 percentage point to headline inflation, right? So it's a weird thing to think about, that as the Bank of Canada raises rates, it pushes up the one component of the CPI basket, which is interest costs, right? So they end up in this situation where they're chasing their tail. As they cut those rates, and as that filters through, that CPI, that mortgage interest cost component, will basically drop to zero as well. And so you're gonna have this 0.9-ish percentage point kind of suppression on CPI that's going to offset some of that inflationary dynamics from the weaker currency. That's going to give them time. So that's why I still think that everything we're talking about is a second half story, right? But it is a very different inflationary dynamic than it was during COVID. And I think, one of the things that you could say is I think in COVID, you could have made the argument more credibly that it was transitory. It's a lot more difficult today because, we don't know about these tariffs. We don't know about the currency. Like there's elements within that like you just don't know. Like during COVID, you kind of had the sense that this was exceptional and we were returning to normal. We don't know what normal is going to look like if you get these permanent tariffs come in. We don't know what that's going to do.
And my final question to you on this front is, what about whether it makes an impact on Canadian behavior going forward? So even if this heat is, taken down by Washington, we just wanted to stop the amazing fentanyl flows over the border. Question mark, question mark, question mark. What are the chances that Canada structurally changes? We are a trading nation predicated on a massive trading relationships with the United States. There is some talk that we cannot go back to that structure, no matter what. That would introduce more structural change, I would think. And Canadians might have to get used to a bit more inflation, because the one thing about really free trade is it brings the cost of goods down. If you want to be more reliant and self-reliant and even maybe search out new markets, that introduces inflation, maybe of the more structural kind.
100% agree. And I actually think if you wanted to sort of take the optimistic view on all of this, it's that, for the first time that I can recall, we have a lot of, we're very galvanized around this idea that we need to diversify our exports. We need to look beyond just one partner. And man, I've never seen this much support for building pipelines, trying to get energy to the coast, trying to get it to European or Asian markets. That can be a game changer, especially if you think that the federal government does have some leeway in their budget and their balance sheet to aggressively push towards major infrastructure investments, especially things like pipelines. That can be a real game changer. That not only is that highly stimulated for the economy in the short term, but over the longer term, that can have just enormous economic impacts in terms of reducing the discount that we sell our oil, opening up new markets. Turns out there actually is a business case for liquefied natural gas, like all this fun stuff. We may look back in a decade and realize that this was a shift and it ended up net being positive over the longer term, even if it creates this sort of near-term disruption and pain. So I do think we see that there's a potential here for real permanent change in Canadians' thinking and unity around these topics.
Depends, I think, as always, is how quick, because I've just been, I started my career in the civil service in the trade space. It depends how quickly we go back to the easiest option, which has been the United States. But if this feeling really hits, and it hits for longer, I think you're right. I think we'll see some of that transition, but it will hit our pocketbooks. And I think no matter what we do and no matter what the effect is in the long term, and in that front, John, I want to throw it back to you. We know pre-construction sales are really, really down, but housing starts continue. So there are a number of buildings sold. Returning to you, John, about and some questions for Ben as well. What do we think this is going to look like in terms of, fine, we have houses kind of sitting there, are prices going to sit there? What is this going to mean for the homes in the pipeline, much less the ones that can't be sold right now at all?
And what do housing starts look like in the months and years ahead? I mean, they've been softening. They're still pretty strong, considering. But where do you see them going in the next 6 to 12 months?
So I think they're going to go a lot lower. And there's a couple of reasons for that. One is when you look at condo starts in particular, they have not yet realigned with the trend in pre-construction sales, right? So we know that pre-construction is effectively dead. You can't build, the condo developers cannot build large developments without pre-selling typically 70, 75%. Well, if they can't sell them, they can't break ground. So there's this really clear relationship, typically with like kind of 18 to 24 month lag between pre-construction sales and housing starts. So housing starts are like condo starts are trending lower, but they've got a long ways to go to realign with what we're seeing in the new construction space, or the pre-sale space, I should say. What's kind of kept housing starts artificially high has been the rental segment. So as an example, we just got the February data. We had 51% of all housing starts in Canada were rentals. In 35 years of data, we've never seen that.
Purpose-built
So
rentals, Ben?
Yeah,
purpose-built
rentals.
rentals.
Yeah.
Yeah. So this is, if you look at like, so this is actually interesting. Over the last 12 months, we've actually seen now condos have seen the lowest levels of starts, then single family, and then rentals are by far the highest. So again, like we've never seen condos this low, right?
Mhm.
Like relative to everything else. So it's like um, it's a strange time. You're seeing tremendous activity in the rental space, weakness in the condo market that's probably going to get a lot worse, and
Mhm.
single family is just kind of muddying along at pretty low levels.
Mhm.
So where it's going to get interesting is as you look forward, right? So the single family market is unquestionably going to be undersupplied in coming years, even with the dramatic reduction in population growth that's on deck, right? Which we haven't talked about, but I assume by
Mhm.
now most Canadians understand that we're transitioning to an era where immigration will not be quite as loose as it has been, particularly as it relates to temporary residents, right? Um, Even with that said, you can make a really clear case that single family will be undersupplied. In maybe it'll take a year to work through some of this inventory and tariff issues, maybe 2 years, who knows? But at some point, it's going to be very clear that we're not building enough single family. Condos are going to take a little longer because of how much is still in the construction pipeline and how much is sitting, as you guys know, unsold. But even there, if we're right that condo starts are going to fall to pretty not zero, but like we're talking like a handful of 1,000 units next year for starts. Well, you roll that forward 3 or 4 years, and those completions that should have been there won't be, right? We'll be down to like a couple thousand completions. Now, that may not be a story until 27, 28. But even there, you can see that the condo market will be dramatically undersupplied at some point in the future. So, all that to say, like, we're not building enough. It's clear it's not a story for today, because if anything, there's, as you guys know, there's lots of resale supply, prices are grinding lower, but you can see where that's going to be an issue down the road. A little different for rentals. I mean, I think that the rental market has gotten way too far ahead of itself. We've got 160,000, almost 165,000 purpose-built rentals in the construction pipeline across the country. That's the equivalent of about 6% of the existing rental stock, which is enormous, right? And that's going to complete into an environment where, if you believe the federal government, you're going to have a decline in temporary residents, which has been the main source of incremental rental demand over the last few years. So in other words, you may have an expansion in the rental supply of somewhere in order of 5%, 6% into an environment of flat or negative rental growth, rental demand growth. We're already starting to see it. If you look at the publicly traded REITs, you look at their reported occupancies, they're falling, particularly in Alberta and Ontario. I think that's going to accelerate. So you have the situation where developers are just charging ahead full bore on rentals into what looks like a very soft period of rental demand. I don't think that's going to end well.
And I was curious on your thoughts on that. So they see that the demand's going to be soft. They see rents are kind of trending down. So what is the motivation for all of the new rental construction? I mean, of course, we had, the GST waived on purpose-built rentals. Of course, the government's helping, builders finance at ultra low rates. Is it
Well, that's
just
it right there, John.
But,
I don't
but
think you
is
need to say
it,
anything more than
I
that.
don't think that's an of course. I think that's
is that
driving
it?
it.
And like,
Yeah,
and
that's it right there. Like, I
okay.
think, John, so people always invest based on the rearview mirror, right?
Mhm.
So rentals have been an amazing investment for so long in Canada. And we have been extremely undersupplied for rentals. Of course, you will be when you add 800,000 temporary residents in a year. Naturally, you're going to have a rental crisis. So what CMHC's MLS programs have done is really make financing incredibly cheap and available to not just developers, but people looking to acquire those rentals. And so if you're a developer, you know that you've got an offtake agreement with an end user for your project, and they're going to backfill. They're going to get their insurance through CMHC, their financing through CMHC. It's going to get taken out. So why wouldn't you build it, right? The issue is just going to be, I think, more. I think the realization is going to set in next year that the rental market is going to go through a period of softness for a while, and you could see more downside in rents. You guys know rents are coming down in most of Southern Ontario. I think there's probably still some room for it to fall, but like everything else, it's like, the other thing I think people need to realize is like, speculation dies hard, right? And one of the things that we've seen is the buyers that used to be purchasing pre-construction condos in Toronto have transitioned into buying MLI select insured rental properties in other parts of the country, right? So, it's just a different form of speculation. This one's government backed. I'm not going to say it's going to end as badly as it appears to be ending in the condo market, but it does not look like a great bet at this point.
What the programs that they're betting in, the MLI Select multi-res.
Yeah.
I agree with you. They look terrible. I don't know what they're thinking, some of these people.
So
Listen,
I'm
but
gonna push back a little bit on this.
okay.
Because it seems to me that we're sleeping on a bit of a success story if the federal government could actually claim one.
Oh yeah,
Oh,
for sure. With housing.
it's been incredibly successful.
Hasn't
Yeah.
claimed it. Here they're tremendous. One thing they can do is use their financing power to actually make an impact, not these weird little initiatives, first time buyer, rent relief. These things are terrible. And they make no impact. But here they've gone and used their financing power to offer low cost loans towards an industry that they want to see more building on.
Yep.
So I have a couple of questions around this. Is this not a smart tool for the government to get smarter around in a couple ways? If we see overbuilding starting to happen in one segment, that rolls in. If we think that condos, developers need to be encouraged to build family-size flats, like if we think density is going to be the way to go and the best way to house all these new people, couldn't they use this kind of instrument in a way that avoids the market-led speculation? And by that I mean, okay, fine, it's true the condos provided some rental, more than some. They provided a lot of the new rentals that we did at a time where government came right out of that sector. But isn't it the case that when you leave it to the market, you see these really big high and lows fluctuations? And if the government was smart, they could use these financing incentives to iron a bit of that out.
Yeah, absolutely. I think that's smart. The key point, though, is you need the government to be counter-cyclical, right? So you need the government to step in to smooth the cycles. You don't want the government stepping in to be pro-cyclical and create even larger swings. So you're right. The MLI Select program is a resounding success. It probably should have started to be tightened 6-12 months ago, right? And maybe you transition that to, as you said, maybe looking more towards underpinning some of the pressures we're seeing in the condo market with an eye towards those long-term shortages. I don't disagree. I think government has a role to play in encouraging certain built forms. It's just like everything else. We seem like we like to fight the last fight, right? Like if there's a crisis somewhere, we will.
Or we'll just fuel on it.
Yeah, like by the time we recognize that something's a crisis, oftentimes the market's starting to work towards a solution. Not always, right? Sometimes you get municipalities step in the way and hinder construction of whatever. But oftentimes you'll see the market's already moving towards a resolution, and then the government comes in with their solution and they kind of overcorrect on the other side. And I think that's what we're seeing with rentals right now. And the other thing you got to keep in mind is and this is getting really into the weeds, but the MLI program, remember, to get the financing.
To clarify for people, that's the program that the CMHC uses to finance new rental construction, right? At ultra low rates.
Yeah. So either finance the construction or also the acquisition of existing rentals. And so, it's got these weird criteria where you have to hit 100 points across a couple of metrics. And one of them is affordability. So it's turned out that because the Alberta markets are, the rents are so affordable that developers can qualify for their MLI financing much easier in Alberta. So what are we seeing? We're seeing a massive amount of rental construction in Alberta where it's probably not needed as much and not nearly as much in say, Toronto, because those same builders can't hit those affordability criteria because the pro formas don't work, right? So, it's a program that has a lot of potential, but feels to me like it's solving a problem that was a 2-year-old problem.
Right, and might be egging it up. That's my
The,
a final question I have on this for myself is what are we seeing happening? So for a long time in the rental purpose-built sector, we had large operators. So once these buildings are built, they're sold to large firms. I remember Germany having a strength in it, other international companies. There are some Canadian operators. They basically then take the buildings over, they operate them, they look for long-term rent stability. So they're not looking for the highest rent hikes, but over time you invest, you get money back for your pension or your portfolio. Now, what's happening with this boom? Is that nature changing a bit? Are we seeing some builders who couldn't get their condo stuff done flipping into this purpose-built space and going into the operating space themselves? And is that in itself a little bit more unstable or something different from what we've seen? Or are they all expecting to sell it to operators as soon as they
Yeah,
close?
that's a good question. I don't have a lot of clarity into who the specific developers are that are building it. I mean, anecdotally, I think we've all heard that there's been a number of developments that have shifted from condo to purpose built because of the financing angle, and the pro formas just don't really work on condos at these prices. So I think there's something to be said for that. I don't have great insight into specifically who the developers are. What I do think your point is well made though. Like one of the concerns has been that, and John, you and I disagree on this, and this will be an interesting discussion.
all
So
right, go.
a lot of people have this this a lot of unease around institutional landlords, right? And I understand it from one perspective, right? So you don't necessarily want the Blackstones of the world coming in and buying entire cities of single family homes. That said, I think the idea of having an owner that has a long-term view, right, that is looking towards stability of rental supply, as opposed to mom and pop investors who, if the prices rise 20 or 25% a year, maybe like, great, let's cash out, right? And we've seen that. We see when you have mom and pop investors as the primary source of rental supply, it just has, you don't get those long, stable rental supply that we would need, right? And so I have no problem with having institutional investors step in. I think that's what we need for this market, as long as there's some reasonable restrictions around, not having them kind of corner a market.
So, but to be clear, you're not talking about institutional investors buying purpose-built rentals because everyone agrees on that. You're talking about them buying single-family homes, basically. Is that
Yeah,
just
see, I don't have an issue. See, in my mind, I don't know why renters can't have backyards,
they can?
right? Like,
Sure.
right. So, well,
But
who's
that's
going to
not
provide them with the backyards, right? So if we're in agreement that we want people with a long time horizon owning these rentals, so that we're not constantly churning and forcing people to move. Well, then who's going to be the owner of those single family rentals if it's not an institution?
all right. I'll give the alternate perspective. I mean, listen, I think again, if we're talking about institutional landlords building brand new detached homes that are going to be permanent
Yes.
rentals, completely different. They're called
Yeah, I
built
agree with
to
that.
rent. So I don't have
Yep.
issue with that, but what we're talking about with this issue is them coming in and like what they're doing in many of the US states is just buying up tons of homes in existing neighborhoods, right? And the question is this a good thing or it's a bad thing? I think the challenge that I have with it is that, listen, at the end of the day, the role of housing has fundamentally changed in our society. Okay. 30 years ago, 40 years ago, every suburban low rise home was for Canadian families. They were built to be owner occupied and raise your family, and not just raise your family for security of tenure, but it is entirely part of Canada's welfare state. We don't invest in people's welfare needs when they're seniors because the state expects us to invest ourselves, own housing, and this is fundamentally one of the things that makes us different from the US, right? So when more of our housing stock is being converted into long-term assets, the issue with the purpose-built, like the institutional investors, is those homes are almost always permanently gone. It is actually shrinking the stock of owner-occupied homes because when an institutional investor wants to get out of the housing market, they don't go out and sell 10,000 homes individually. They sell to another institutional investor. So what we're talking about is we already don't have a lot of homes that can be owner occupied. And we're talking about shrinking them even further. So Blackstone can kind of basically build a portfolio of homes that would otherwise have been occupied by families. But you know what? Let's pad their investments and make them a little bit more profitable. And I don't think that's great. Like, I think this shift in the role that houses are playing in our society is not great. I think most Canadians would rather have a long-term home. To your point, shouldn't renters have a backyard? Sure, but I can almost guarantee you the vast majority of people who are renting from an institutional landlord would rather be able to buy that home. Like, they don't want to pay Blackstone's mortgage. So, I mean, again, I think it's a different view. I think the path that we're on isn't a good one, where our home ownership rates are plummeting because there are fewer homes that can be owner occupied. And that's exactly what's happening.
Well, and is there a pessimism there, Ben, that we're admitting that our model is totally broken, and the idea that you can never get a backyard unless you're renting it. It seems like that traditional pathway of at least paying less while you're renting so you can save up and get into something you can own, which has been a traditional wealth builder for most. If we're now admitting that that's it, they're never going to get that backyard, are we just admitting that whole thing's broken? I think that would be a tremendous societal change, no?
Yeah, we're basically saying we're admitting the entire generation are stuck being renters because home prices are 10 times income. And too bad.
Yeah, I mean, but that's how it is right now, right? The affordability is not good.
I know, but why is that a good thing? Why is that a good thing?
No, it's not necessarily. First of all, look, this is a moot point because the economics of trying to scale single family rentals is not there in Canada like it is in the US. So you can do this in the US because they actually carry, and they're not even close to carrying. So like, you would need prices dramatically lower to even make this a viable discussion. And every other time that you've heard an announcement of an institutional player coming into the single family space in Canada, they really quickly realize that the economics don't work. It's not a scalable model. So look, this is a hypothetical discussion at this point, but you know, the only thing I would say is, what is the optimal ownership rate? Like, is it Quebec's where you're kind of in the high 50s? Is it Europe's where it's like, you know what I mean? Like, we're assuming that 70% is the right number, right? Or 60, 65 or whatever it might be. But like, it's a lot of countries that function perfectly well with much lower ownership rates. And remember, the institutional investors are often pensions. They're Canadian pensions that are managing our retirement savings.
And I mean, to be clear, I'm not as concerned about if home ownership rates are declining because we're building tons of purpose-built long-term rentals. That's different, but that's not what's happening. They're plummeting because many of the homes that used to be owner-occupied are being bought up. And that's a different way of supplying the rental market. You're not supplying anything.
Yeah.
You're not adding new supply.
Yeah.
Like,
so so again, let me just push back on one point. So, do we agree that there's individual retail investors that are already doing this? They're already buying single family as rentals. Okay. So,
it's not.
So if it's happening, so all I'm saying is
they're bigger than the.
So all I'm saying, right? So my only point is, if we're okay with that dynamic, you should be okay with institutions doing it. And they should be the ones doing it, because at least if you've got people trying to provide single family rentals, it's not mom and pops that are prone to, you know, flipping and churning and selling and doing all sorts of stupid stuff.
Yeah.
You know, you've got actual professional landlords running it.
Sure, but that's a difference, because I'm not even fine with all of the big boom in the mom and pops. Like, I think this is part of the problem. Like, I see it as a problem. Listen, it's not a problem if, like, you and me are going out and buying assets. Like you said, if prices dip, I go out with 5. We're making money. Our generation is 100% fine. We're loading up on assets. So we are just doing just fine. The generation older than me is doing just fine. But the younger generation is kind of getting screwed. So I think that's the tension. It's either the more profitable it is for our generation, the less affordable it is for the next. And it is a tension I have a problem with. So I'm not even fine with this massive shift that Canada has, even with the mom and pop investors. And the solutions aren't easy.
Yeah, that's fair.
But anyhow,
that's fair.
Just to move forward, because we're going to wrap up soon. One thing I wanted to ask you was how you see the condo market, in particular, the new completions that are in the pipeline. I mean, you tweeted about one, I think that you saw this assignment sale. Someone had bought a pre-con unit for like $1 million and they're trying to dump it for 700 grand and they can't. So taking a $300,000 hit. And this is going to be the story of most condo completions in 2025 and in 2026. We're starting to hear that banks are going to be less inclined to do blanket appraisals. And for those who don't know that, it's just kind of closing their eyes and pretending the unit is worth what the investor paid for it. In this example, assuming it's worth $1 million, even though it's only worth 700, that's going to be less likely. So how does this play out? Do we see people just defaulting on units? Like, what do you think is going to happen?
Yeah, I think we've got a real problem in that space. So I think that as we move through 2025 and 2026, you will see the default rate on closing rise from, I'm hearing already you're seeing buildings with 20% default rates. I think that's going to go 30, potentially 40%. Like, I think it's going to get really high. I actually think my conviction is that the bottom of this cycle will happen when CMHC comes in with some form of support for builders. And I think what that will probably look like is like they're going to need, so in order to get all these banks repaid on these development loans, they're going to have to do something. So what would that look like? I think you will see CMHC come in with some sort of like a interest-free inventory management loan for developers that allows them to repay the development loan and manage the sale of their existing units, sort of trickle them out of the market so they don't kind of blow out the market and flood it with inventory. I don't, barring that, I don't know what prevents like a real fallout in this space, because these units, like, they're just so far offside, a lot of these. I don't know why anybody would be closing on them. And I don't know, especially if banks aren't going to be playing games with blanket appraisals, I don't know how they're going to get their financing to close for a lot of them. So it's a real pickle. It's going to get uglier before it gets better. That whole CMHC thing is probably not like a story for 2026. But I think that's where we're going. You're going to need some form of government involvement to unwind some of this and prevent the banks from taking what I think are potentially significant impairments on some of these loans.
So basically, everyone's a free market person until they need a bailout, which is
the Canadian way, John.
Which is what we're gonna.
I'm not saying I like it. I want to be really clear. I'm not saying I like any of that, but that's I don't know how else we do it.
I mean, we see it in financial collapses.
100%. Of course, it's not new. Yes.
Let's bail out GM. Let's bail out everyone else. I want to, just before our time is over, return to a little bit more of a blue sky question again, bringing together this housing question with a bit of macro. So if we are looking at tariffs and thinking, okay, maybe Canada restructures finally, does some things that it needed to be doing, I am wondering if by propping up and keeping these prices up in the Canadian market and not allowing a fall or a fallout in this sector, are we not doing something in Canada where we're tying up a lot of our productivity in our overpriced housing, and it's hitting our productivity, which we've seen fall over the last few decades? I personally think there's a connection between how many people are in real estate and, to John's point, the mom and pop investors. A certain level is fine, but when every other person's in the business, it's not only taking out supply that end users would like to own, I would argue they're not putting it into other productive means. Small business, medium business, improving their businesses. So is there not a chance for Canada to structurally change a little bit if we would finally let these prices fall a bit?
Okay, so the prices would be one. So it would be a good thing. I agree with you. It would be a good thing to remove some of the speculative froth and this kind of like real estate only goes up mentality. 100% agree with you. Downer prices could certainly do that. But I also think we need a rethink of just tax policy to disincentivize overinvestment in real estate and try to incentivize investment in productive ventures. So, for example, I mean, I've raised this point before, and I mean, I take so much crap for saying this, but like, it's true. I mean, you want to get rich in this country. Is it easier to try to invest in a business, take all those risks, scale it, grow it, hire, manage employees, and then down the road sell it? Or is it easier to just like borrow as much as you can and buy the biggest house that you can and let those tax-free capital gains accrue to you? Right? Like, clearly it's number two. So you want to create a system where we reward investment in productive ventures. We want to be a more creative and an entrepreneurial society, and that does not happen when capital is so inclined to flow into residential real estate as opposed to business investment. So falling prices would do it. A rethinking of taxes would certainly do it as well. And those two things together, I think, could really change.
So are you
the
suggesting then we, rethinking of tax, you introduce tax measures that disincentivize the hoarding of real estate to incentivize productive investments? Because that's what I think. I don't think you ban investor. I don't think it's stupid like that, but it needs to be less lucrative. And maybe you get rid of the capital gains exemption. Maybe the profit on investment properties. Oh,
John, you're going to take so much crap for saying that.
Buddy, I don't care. At the end of the day, what is the disincentive then, Ben? What is the disincentive? Like, I'm asking you.
I've said it. No, you and I are in complete agreement on this. I've said it as well. So I think, first of all, it would make more sense to try to cut the taxes on businesses than to try to raise the tax on residential real estate. From a political perspective, it's just never going to fly. But I'm with you. It makes no sense that we have.
Sorry, to be clear, I'm not talking about getting rid of the capital gains on principal residence. I'm talking about investment.
Oh, I thought that's what you were saying.
No, not principal residences. I'm talking about like the investment property people. Like, make that less lucrative, not principal residence.
Both of your points. Wasn't it a bit of a miss for the federal government when they decided to go after capital gains over a certain amount? They could have put that on the real estate market specifically, rather than catching in its net all of these
all the businesses, exactly.
All the businesses,
So this is a great example of how these really rough tools are put on everybody, and there's no thinking, oh, our productivity is down. What might be hitting that, So I don't know if that I understand that it's probably a no-go, the amount of construction jobs we would lose, the amount of even sales and service jobs. I mean, real estate is a huge GDP contributor.
But I don't even think so, because you have purpose-built rental going up. You don't necessarily need everyone to be a mom and pop investor. This is what people were saying 10 years ago. So the only way to build rental housing, you need investors to buy condos. Obviously, that's not the only way. Right. And I think this is a period where you could potentially shift, because investing's not as big of a deal right now. Like, if there's going to be some shift in policy to incentivize investment in businesses, disincentivize hoarding of real estate, now's kind of the time to do that. Right. And then maybe that's where we agree, because I think that's a bet. And that goes, again, this is more about like, what is the vision you want for Canada? More productive, more investment in businesses, fewer people hoarding homes, because it means more families can buy them. You know what I mean?
Yep.
All of that stuff.
I think the final piece to that would be the government at least allowing rental stock to increase to a degree where rents do fall on a more permanent basis. Again, when you unleash that ability of young professionals to team up, to start businesses, to use their extra capital not on paying rent or the revenue, it's huge. So I just do wonder about whether to pay one part of our market and make sure they're whole, we're not, just permanently, hamstringing this other part, and then we bemoan our productivity. So I don't know. I don't see this connection being made at a higher level, but I'm wondering if you're seeing some of that, Ben, or if you hear, like, I go to a lot of seminars about our falling productivity, but I'm not hearing it like really related to our dependence on housing as much as I would think makes sense to do that linkage.
Oh, I think it's a perfectly clear linkage. I mean, I've been on that for a while, that particular story. I agree with you. I think there's some, depending on the political party, I think there's some receptiveness in certain circles. And I would say that I think it's more related to incentivizing business investment as opposed to disincentivizing real estate at this point. And that's the easier lever to pull, right? Cutting business tax or some sort of additional tax credits to stimulate new business formations. That's the easier lever to pull.
But not as powerful, I think. I think not as
I don't
powerful as
disagree,
maybe
but if you think about
investment.
100%, but you got to think, you got to put yourself in the
How are you
perspective
going
of
to
a
get elected?
politician who wants to run, hey, we want to tax your housing. Like, have fun never being elected. You know what I mean? Like, so in terms of what's doable, to me, that trying to make it more, trying to incentivize business investment as opposed to disincentivizing real estate investment is just the easier lever.
Yeah.
Awesome.
Yeah.
Ben, thank you so much for taking the time today. It was a very fun and informative chat. Yes, it's very not heated. We found some common
I think
ground.
a good lively
Right?
discussion. Yeah.
Listen, I think it's
well,
always
we've been having this discussion forever. It's good. It's good to have these discussions.
Because I
100%,
don't think we're hearing enough of that push and pull in Canada. Like we do have an issue with the consensus, right? So I think it's really important to ask these questions. And same thing. I as a longtime tariff analyst, like I'm really hoping this will result in long-term macroeconomic change for Canada, but I'm not sure. We have a way of going back to our old ways as soon as the sky clears up,
Yeah, I hear you. And it's also important to note that so much of the housing discourse in Canada is so divisive and polarizing that it's good to get on a call and have a good natured discussion where we can find common ground and, hopefully just, try to model that out for some people. Because as we know, the dialogue, especially on social media, is not always constructive.
Right? The Canadian way before Fox News wasn't to score points so you feel good. It was to try and arrive at some better policy, right? Call it old-fashioned, and then to at least look at your opponents in the eye as colleagues. So yeah,
awesome.
We're modeling that.
Good stuff.
Beautiful. Ben, thank you so much. Hopefully we'll have you on sooner next time, but thanks again for all your insights.
Appreciate it, guys. Have a great one.